Welcome, dear traders. Last week, Wall Street saw an upward reversal. All three main stock indexes are likely to put an end to their long weekly losing streak. Stocks have been rising for 3 sessions in a row after the publication of the Fed's dovish minutes. The equity market notched the biggest gains last Friday. However, the reasons for optimism and an upward reversal are not completely clear. Analysts have contradictory opinions on the drivers of the current rally. The new week is going to be quite tense as traders are anticipating crucial economic reports. The United States will unveil its non-farm payrolls report for May, and this data is sure to be in the limelight. The ISM manufacturing and services PMI indexes are also due. Apart from that, several Fed policymakers will deliver their speeches. Traders hope to get more clues about the Fed's future plans on a monetary policy. The coming seasons will show whether the stock market is really set to recover or we are now witnessing a short-term correction. Make yourself comfortable, watch our video review and share your opinion in the comments down below. The Fed's meeting minutes were the main highlight of the last week. Although the minutes did not contain anything new, the market reaction was instant. Fed officials agreed to move its benchmark policy rate closer to a neutral level. Some policymakers said about the possibility of a slowdown in inflation. Investors' expectations for inflation for the next 5 years fell to 2.8% in April, after the March peak of 3.5%. The regulator continues to make policy decisions with a strong labor market and inflation risks in focus. It also expects GDP growth in the current quarter amid stable consumption, expenditures and business investments. The meeting minutes confirmed that the revised economic forecast will be revealed at the June meeting. Many investors were puzzled by the dovish tone of the Fed's minutes. The regulator stressed it would not hike the cash rate more aggressively. Analysts reckon that the watchdog might be hinting at a possible pause in its tightening cycle. Meanwhile, the GDP report for the first quarter, which turned out to be weaker than expected, was almost ignored by market participants. Perhaps traders remained calm because they had already priced in rate hikes by 0.5% at the next 2 meetings. So they are confident that the regulator will not adjust its short-term plan. What's more, downbeat GDP data was eclipsed later by an increase in consumption expenditures. The indicator turned out to be better than the forecasts. It was a signal that consumer spending remained steady and could facilitate GDP growth this year. Personal consumption expenditures data also spurred optimism. It appears inflationary pressure eased in April, and traders are sure to take notice of this report as the Fed pays great attention to this indicator. Bulls are coming back to the stock market as there are more and more signals that the Fed will not undertake more aggressive rate hikes in the future. This was the main catalyst for an upward reversal on Wall Street. The 3 main stock indexes jumped by more than 6% last week. The Dow and the S&P 500 looked their best weekly performance since November 2020. Last Friday, the Dow gained almost 600 or 1.7%, approaching 33,500. A further rise in stocks will depend on fresh market events and reports. This week, investors are waiting with a bated breath for the non-farm payrolls report. The Fed is closely monitoring indicators of the labor market. An increase in unemployment may be a reason for less aggressive rate hikes. Notably, traders shrugged off recession fears last week, and they ignored weak GDP figures for the first quarter. Yet they are unlikely to overlook the same data for the second quarter. Analysts believe that there is a high probability of a negative reading. According to the Atlanta Fed GDP Now model, the economy was expected to expand by 1.8% in the second quarter. However, the figure has been steadily declining lately. Taking into account that inflation has already reached 8%, traders should also brace for unpleasant surprises. As for the S&P 500 index, it ended last week on a positive note. It closed Friday's session with an increase of 2.4%. On May 30, the US trading floors were closed on the occasion of Memorial Day. As the S&P 500 still maintains bullish momentum, traders are expecting a trend reversal. Since the beginning of the week, the index has been rising beyondly. Moreover, the previous forecast suggesting a fall to 3,855 points and below did not come true. The S&P 500 was gradually moving higher, eventually breaking through the psychologically important level of 4,000 points. Thus, it escaped the downtrend channel formed in early April. What does this mean, and what levels may the index reach in the coming sessions? The target levels were 491 points and 4,128 points. A breakout has already occurred, boosting a further rise, albeit within a correction. The index is likely to climb to 4,270 and then to 4,310. Despite an impressive rebound, analysts consider it a bearish trend rally. Last week's recovery is viewed as a correction, as the medium-term technical outlook is not clear. The risk of a possible drop below 3,855 is still quite high. To resume a downward movement, the peers need to push the price to the short-term support level of 3,930 points. Now, let's move on to the next stock index. The high-tech NASDAQ added 3.3% in one session at the end of the last trading week, and this is the best result among the main US stock indexes. The index broke above the 12,100 level. The future prospects are somewhat cloudy. The NASDAQ dropped by 27% in the first 5 months, noting the worst performance in history in early 2022. The reason for a bearish bias was a sell-off of the overbought fast-growing tech stocks due to high inflation and the monetary policy tightening. The chances of a steady recovery of stocks remain slim until the Fed takes a more dovish approach to monetary policy. Upbeat earnings reports and outlooks of the US largest companies may also stimulate the revival on Wall Street. The ongoing earnings season has been rather disappointing so far. Companies continue to surprise traders in a bad way, triggering huge declines in stocks. For instance, Nvidia shares sank by more than 11% after the release of their quarterly report. However, they were able to recover by 5% after the volatile session. The earnings report itself was positive. Investors were taken aback by the gloomy outlook because of the supply chain disruptions, the termination of work in Russia, and the lockdowns in China. The sell-off in the equity market is hardly over. Nevertheless, there are stocks that deserve special attention. The software and services provider Palantir was once one of the biggest gainers in the market. However, its stock also lost luster with the traders. Since the beginning of the year, its shares have fallen by 54% amid falling demand for tech stocks due to monetary tightening. Adjusted earnings per share were shy of the forecast. It was twice as low as in the same period last year. However, in annual terms, the company's revenue increased by 31%, exceeding market expectations. The US commercial revenue soared by 136%. The software company issued a weaker-than-expected revenue outlook for the first quarter, even though Palantir is starting to see acceleration from the government revenue in the second half of the year thanks to contracts. For the full year of 2022, it expects an adjusted operating margin of 27%. Palantir hopes to post annual revenue growth of 30% or greater through 2025. Keep close tab on market developments together with InstaForex TV channel. We would be extremely happy to receive your feedback, and we work for you, shooting video reviews every day and every week. And that's all for now. See you soon.